What if one of the most beaten down AI stocks right now is actually sitting on a much bigger opportunity than the market expects? Veritone, or VERI, is trading around the $1 area. And honestly, the chart doesn't look pretty. The company is still losing money. Cash is a concern. Debt is a concern. And investors reacted badly to its latest results. So why am I still watching this stock? Because underneath all that negativity, there are 5 things that could potentially change the entire story. But here's the twist. Those 5 reasons only matter if Veritone can survive long enough to execute. Reason number 1, Veritone already has a real AI business. This isn't a company that simply added AI to its name because AI stocks are popular. Veritone has been developing artificial intelligence and data technologies for years. Its platform helps organizations analyze huge amounts of unstructured information and automate workflows. That gives Veritone something many speculative AI companies don't have: an existing enterprise platform and real customers. The big question is whether it can turn that technology into consistent, profitable growth. Reason number 2, Veritone Data Refinery could become a major growth engine. Management has highlighted strong demand and a pipeline of opportunities worth more than $65 million. Now let's be very clear. A pipeline is not revenue. Those deals still have to close. But if Veritone converts a meaningful portion of that pipeline into actual sales, the revenue picture could change quickly. And that's what makes this stock interesting. The market is focused heavily on what can go wrong, but what if those deals actually start converting? Reason number 3 is cost cutting. Veritone has been aggressively reducing expenses, targeting roughly $15 million to $20 million in annualized savings by the end of 2026. This could be extremely important. Veritone doesn't necessarily need explosive revenue growth to improve its financial position. If revenue grows while expenses fall, the company could move much closer to operating profitability. Management has talked about reaching operating profitability in the first half of 2027. If that happens, investor sentiment could change dramatically. Reason number 4 is valuation. VERI has already been heavily punished, but a falling stock is not automatically a bargain. Sometimes a stock falls because the business is broken. Other times the market becomes so pessimistic that even a small improvement creates a huge percentage move. At around $1, VERI is being treated like a very high-risk turnaround. That creates serious upside potential if management executes, but also serious downside if they don't. Reason number 5 is government and enterprise AI demand. Veritone has exposure to government and public sector applications where organizations increasingly need AI systems capable of processing huge amounts of information. If government contracts and enterprise demand accelerate, Veritone could benefit. But there's a problem. Government contracts can take time, and recent funding delays have already affected the company's outlook. Now let's get to the 3 risks. Risk number 1, liquidity. This is probably the biggest issue. Veritone had roughly $12.4 million in cash and cash equivalents at the end of Q2, while also facing significant financial obligations. There are also convertible notes coming due in November 2026. So the question becomes, can Veritone improve its cash generation fast enough? If not, investors could face additional financing, restructuring, or dilution. And dilution is something shareholders definitely don't want. Risk number 2, the company is still losing money. Veritone generated about $24.3 million in Q2 revenue, but it still reported a GAAP net loss of more than $22 million. Yes, the company is cutting costs. Yes, losses can improve. And yes, management expects profitability, but expecting profitability and actually generating sustainable profits are 2 completely different things. Until Veritone proves it can generate positive cash flow, I would consider VERI a speculative investment. Risk number 3 is execution. This might be the most important one. Veritone can have great technology, a huge pipeline, and strong AI demand. But none of that matters if those opportunities don't convert into revenue. That's why the next few quarters could be critical. Investors need to watch revenue growth, VDR bookings, margins, cash, and progress toward profitability. Now let's talk about my price prediction. I don't believe in throwing out crazy targets simply because a company is involved in AI. My base case for VERI is around $150 to $250. If revenue stabilizes, cost reductions work, and the company moves closer to profitability. My bullish case is roughly $3 to $5. That would require stronger execution, improving margins, meaningful VDR growth, and a much healthier balance sheet. And yes, 5+ is possible in an extreme bull case. But that would require Veritone to prove that its AI platform can scale much faster than the market. currently expects. Personally, I wouldn't buy VERI just because it has fallen. I'd want to see the numbers improve, VDR bookings converting into real revenue, the cash situation stabilizing, and most importantly, a clear path toward profitability. Because Veritone doesn't need to become the next Nvidia or Palantir. It simply needs to prove that its AI technology can generate enough recurring and profitable revenue to survive and grow. And that's where I think the real opportunity and the real danger exists. So here's my question for you. Do you think VERI is a deeply undervalued AI turnaround? Or is the market correctly pricing in its financial risks? And if you owned VERI today, would you hold for 3-5 or sell before it gets there? Drop your opinion in the comments. And if you enjoy these deep dives into small cap, AI stocks with potentially massive upside, but equally serious risks, I'll make sure you subscribe because the next AI stock we analyze could be even more interesting than Veritone.